Today, we've got a wild one for you. We're going to unpack a truly shocking financial story, a story where a major bank took a massive, and I mean massive, intentional hit to its own bottom line. We're talking about erasing nearly ₦1 trillion from its books, on purpose.
All right, let's just jump right in with the big, scary number. Look at this. In its 2025 financial results, First HoldCo's profit after tax, well, it didn't just drop, it completely collapsed. We're talking a jaw-dropping 93.3% decline from the year before. Just wow.
But here's the kicker, right? This wasn't some accident. It wasn't a market crash that caught them off guard. Nope. This was a deliberate, fully calculated strategy. And that, of course, raises the big question. Why on earth would a successful bank do this to itself? It just seems to go against everything we know about business.
So, to get our heads around their logic, we've got to dig into the numbers. Let's unpack this shocking drop and figure out exactly where all that money went.
Okay, so take a look at the actual figures here. The profit just plummeted. It went from nearly 789 billion naira in 2024 all the way down to just under 53 billion in 2025. I mean, that is a massive swing. So what was the one thing that caused this nosedive?
And here it is, the smoking gun. This staggering number right here. The bank chose to book a 748.1 billion naira loss to cover bad loans. That one single line item, that's the key to this whole story, and it leads us straight to the strategy behind it all.
So, this incredibly aggressive move, it's actually a classic financial play. In the industry, they call it the kitchen sink strategy. And yeah, it's bold, it's super painful in the short term, but it is all about the future.
So what exactly is the kitchen sink strategy? Well, the idea is pretty simple, actually. Imagine you've got a bunch of old problems, bad news just lingering from the past. Instead of letting them slowly drip out and poison your results for years and years, you decide to throw everything, and I mean everything, including the kitchen sink, into one really bad year. You take a huge hit right now, just rip the Band-Aid off, so that all your future years look way cleaner and much healthier.
Okay, so what were these old problems that needed such a radical solution? What were these wounds that the bank felt it had to deal with so urgently?
Well, they were basically just cleaning house. They were finally getting around to dealing with these lingering bad loans from the whole COVID era, and also tackling some, let's say, problematic insider-related debts that have been sitting on their books for way too long. And the timing? Totally not random. The Central Bank of Nigeria had just ended its policy of forbearance. That's a fancy way of saying it had been letting banks delay recognizing these bad debts. That grace period was officially over.
And this is where you see the payoff. I mean, despite that massive shock to their profits, just look at what happened to their ratio of bad loans, what people in finance call NPLs. It dropped from a really dangerously high 24.7% just a few years back, all the way down to a much, much healthier 7.0% by the end of 2025. So you see, short-term pain for a big long-term gain in the health of their books.
But here's the thing. First HoldCo wasn't doing this in a vacuum. To really get why this move was so significant, we have to look at the bigger picture, the whole banking battlefield, if you will. We need to see how its rivals were reacting to the exact same pressures.
Okay, this table right here is super revealing. It shows the impairment charges, that's the money set aside for bad loans, for all of Nigeria's top-tier banks in 2025. And as you look at the numbers, you start to see two very, very different strategies emerging. It's like there's a clear line in the sand.
So on one side, you've got aggressive cleaners. That's First HoldCo and Zenith Bank. They both took these absolutely massive, eye-watering charges. But then, on the other side, you've got the quality defenders, like UBA and GTCO. They booked much, much lower provisions. Basically, they're signaling, hey, our loan books are already in great shape, we don't need to do all that.
And this brings us to the really crucial point. That huge 93% profit drop, it wasn't a sign of failure at all. It was a calculated, high-stakes bet on the future. It was a conscious, strategic decision to sacrifice today for a much, much stronger tomorrow.
So what's the end game here? Well, the whole point of this incredibly painful exercise was to achieve a fortress balance sheet. Think about that. A financial statement that's so strong, so clean, and so resilient that it's basically untouchable. So, the whole gamble can be broken down into these 4 steps, and the logic is actually pretty simple. Step 1. Take a massive one-time financial hit in 2025. Step 2. Flush out every single legacy bad loan and old issue. Step 3. Enter 2026 with a squeaky clean, strong, and resilient balance sheet. And step 4, be ready to compete when the central bank brings in new, tougher capital requirements for the entire industry. You're basically positioning yourself to be one of the strongest players in a whole new game.
And all of this leaves us with the ultimate cliffhanger for the year ahead, right? With a totally clean slate, but with rivals who chose a very different, much more conservative path. Was this bold, painful strategy the right move? Is First HoldCo's massive gamble on 2026 actually going to pay off? I guess only time will tell.